Hello everybody. So today, kind of a throwback video of the channel. I'm gonna walk through 7 stocks that I find very, very cheap right now. But of course, the subtitle of this video is Growth Stocks Can't Catch a Bid. This is yet another month of the market doing nothing but worry about macro and worry about geopolitics. Now worried about what $100 a barrel price of oil is going to lead and do to inflation, what it's doing to the 10-year, what it's going to do to the mortgage rates. And so the market is yet again doing nothing for yet again another month, and dare I say yet again another year. The 2020s are a lost decade, and because there's a lost decade, that means there's a lot of stocks who are firing on all cylinders and who get no reward whatsoever in the form of the higher share price. These stocks are all firing on all cylinders and they get zero love from the market. So let me begin with the first stock I want to talk about, which is REAX, the Real Brokerage. And by the way, this is the only slide I have, so more of a podcast style video today. But anyways, let's talk about REAX. So REAX down 46% in 52 weeks. This stock not too long ago, before the macro madness that kind of started with the government shutdown of 2025, it was trading above $4, even got to $5. The stock got halved. Yet another stock who got halved. How many stocks did get halved for no reason whatsoever over the past few months? Many of them. But this stock, REAX, just reported they are firing on all cylinder. The growth is stellar. There is no speed bumps whatsoever in the growth of REAX. In fact, if you look at the REAX growth chart, all of the metrics are heading in the right direction, costs getting lower, houses getting sold more and more, new agents coming in, etc. It's a very similar annual report to SoFi, right? It's all the way up, just like SoFi. And this stock, by the way, seems to be trading based on hopes of rate cuts, essentially. Essentially, the stock has gone down in the past week, despite a stellar earnings report, stellar Q4. It has gone down. Why? Because mortgages are going back up and people are thinking this will impact REAX. Of course, this stock has been able to grow over the past 4 years where we've had nothing but nonsense. This stock has been able to grow. It is still growing at 51%, next 12-month revenue growth predicted. And the price of this stock is enterprise value over gross profit over revenue growth of 0.048, under 0.05. This is very much unloved. This is my play on real estate for when we get the rate cuts, because we will get those rate cuts. I know the market doesn't think we will, but we will eventually get them. And of course, the Rule-of-40 is a 54. And as you'll note, all of the stocks that I cover today just have beautiful metrics. They all achieve a Rule-of-40 or more, and they are all very much inexpensive. So moving on to another stock now, of course, HIMS. HIMS is always inexpensive, and this is despite a rally of more than 50% in the past week. This stock is still very inexpensive at a 0.11 enterprise value over gross profit over revenue growth. Rule of 40 is 43. As a reminder, HIMS has never been expensive in my spreadsheet. The most expensive I've ever seen HIMS was something like a 0.17. Now, you know, this is the EV over GP over RG. That's my spin on the PEG ratio. And the PEG ratio will usually tell you that under 1, it's a good buy. For my metric, I want to see under a 0.5. Under a 0.5, I consider it a good buy. Under like a 0.3, a really good buy. So think about what I'm going to say of a 0.11. HIMS, as the overhang gone. The overhang is gone. The lawsuit from Novo is gone. They can sell branded GLP-1. The GLP FUD that they're going to lose the weight loss business is gone. Everything negative about HIMS is gone. Yet the stock, it went down 70%. I guess we're only down 28% 52 weeks. But, how long are we going to linger in the $24 to $26 range? Could it be months? And could we revert back to 20? Well, if the macro continues, if the market's aversion to growth continues, we could. And it's a complete nonsense. It's been impossible to be a growth investor. But no, I will not buy the index. No, the indexes have not been doing well. I don't want to buy Walmart. I don't want to buy Costco. I don't want to buy stocks with a bunch of debt. No. Moving on, talking about OSCR. So OSCR, my history on this channel, let me tell you about OSCR. I am only interested in OSCR because it is super, super, super cheap. It's 0.004 on my spreadsheet. It's as cheap as I've ever seen it. You may remember a stock like BioStem that I was into back in the day. BioStem was 0.01. OSCR is now 0.004. And why is that? Well, turns out OSCR is predicted to grow 61% revenue growth next 12 months. Why is that? Because their premiums are increasing something like crazy because of the end of the the ACA subsidies, the formerly called Obamacare subsidies. These are going away. And therefore, because of that, there's a lot of people who are going to lose their benefits, and OSCR has to increase the prices by quite a bit. And, if you listen to the call, management is extremely, extremely confident. Like, people, and to quote Cathie Wood on this, I think Cathie Wood also has a very good take. It's like, when faced with financial stress, people, what do they give up? They could give up their house payment, their rent, they could give up their car payment, or they could give up their insurance. And oftentimes, they're going to choose to give up the car payment and agree with the increase in their insurance premium. Why can you give up the car payment nowadays, right? You can give up your car payment nowadays because you can just Uber everywhere and you can get your food delivered all the time, so you don't have to get out of the house as much. So a lot of people, when faced with financial uncertainty, they may decide to keep things like their mortgage or to keep things like their health insurance. At least that's my big take. And OSCR, they have quite a few provisions for people that they think will not renew, but this stock has gotten way, way, way too cheap. The sentiment on OSCR, I cannot understand how negative this sentiment is. I mean, 0.004. Not too long ago, this stock was trading much, 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 much higher. And not to mention, this stock has tremendous optionality after the midterm if there is, for example, a subsidy expansion after the midterm elections, or even before the midterm elections. It could be before the midterm elections. There's a lot of voters that really want these subsidies to be expanded. So you have that optionality, that political optionality, if the subsidies for the ACA were to be expanded. Imagine if they were to be expanded, what would happen to the stock price of OSCR? It would pop. It would pop. OSCR, to me, is a medium-term hold because over the long run, I don't want to be exposed to the health insurance industry. It is not an industry that I like at all. I think it's so heavily regulated, it can't grow very, very fast. But this one, obviously, in my view, got way, way, way too cheap, trading under a 0.01. It's ridiculous. Moving on to Klarna. So, as you know on this channel, I've covered buy now, pay later, the movement, right? Gen Alpha, Gen Z, they don't want credit cards. They grew up with people telling them to hate on credit cards. So they don't want credit cards. They're not interested in that. They want pay in 4, they want pay in 5, they want interest-free pay in 4 for their bigger purchases, and then a debit card, something that asks like a debit card for, I don't know, a sandwich or whatever. This is the concept of companies like Klarna, Affirm, Sezzle. They do these pay in 4 financing, and sometimes you can do more than pay in 4. Like you can do pay in 8, pay in 10, but then you gotta pay interest. But they thrive on transparency. Buy now, pay later thrives on transparency, a bit like HIMS. HIMS too. HIMS thrives on transparency. They have very transparent pricing as to what they're going to pay on the drugs. It's not like the uncertainty of a doctor. This is the same is true for these neo credit card companies, is they know exactly, a customer knows exactly when the payment's going to hit, what the payment's going to be, and the customer also can be stopped in their track. If you listen to the Klarna and Sezzle calls, they both talk about how in the Q4 season, in the holiday season, they were more stringent in their approvals of loans, and sometimes you may get 2 or 3 purchases in Pay in 4, and they won't approve the 4th one or the 5th one because the model tells them, okay, well, we think it's a little risky, so let's not go there, right? Credit cards are not like that. Credit cards are a permanent line of credit, and people can get into major trouble with credit cards, with cash advances at like 37% and all that sort of stuff. If consumer credit is going to be a thing, it is my fundamental belief that companies like Klarna or Affirm are a better business than what the banks have to offer. It's because the rate is sponsored. For Pay in 4 or Pay in 5, the rate is sponsored by the merchant. The customer is very happy to get a sponsored rate. And so it's taking the world by storm, this buy now, pay later system. A lot of young people love it. A lot of young people under 30, they love that stuff. And it aligns with their paycheck. And so why are these stocks so cheap? I have no idea. Someone needs to tell me why JP Morgan is so expensive while their deposits are at literal risk. Well, maybe they're so expensive because they're too big to fail institution. But the point is, anything, if you're going to be super innovative and if you're going to be going against TradFi, the market is not going to give you a premium whatsoever. And to me, these stocks are extremely cheap. Enterprise value over gross profit, over revenue growth is a 0.11. So as cheap as HIMSS. And you know how cheap I think HIMSS is. Predicted to grow 26% next 12 months. We're almost at 30%. Not quite, but almost. EBITDA margin 16%. Gross margin 48% for Klarna. This all looks super good to me. And the stock, by the way, is down 70+% since its IPO. 70+%. I don't understand it. We'll see. We'll see what happens. And then the final few stocks. So I have 2 stocks that I'm going to discuss together. And then I want to talk about Bull. I only put Robinhood in there to compare it to Webull. But talking about SoFi and Nubank. So as you know on this channel, I love both SoFi and Nubank. In the past, I have been unable to choose between SoFi or Nubank. Yes, SoFi is a tad less profitable than Nubank, grows a tad slower than Nubank, but it is also a tad cheaper than Nubank. And Nubank, of course, grows faster, better margins, a lot better Rule-of-40 at 75 for Nubank, but SoFi's Rule-of-40 is excellent at 59, but people will tell me, well, Nubank, they operate in markets that maybe a little riskier, right? Although Nubank is still mostly the leader in Brazil, but a lot of people in Brazil, there's a lot of competition in Brazil. Anyways, people will say it's opaque, of course, because in Latin America, and if you're an investor in the US, you're likely not exposed to Nubank and seeing it operate in Latin America. But what I find very interesting in the Nubank call, the latest call, is how they are going after the US. And this could be a very big deal, going after the US. If they were talking about Florida, Miami, but Florida in general, and what if you were to treat, say, Florida as a Hispanic, land? Like, what if you were to treat it like a Latin American country? It would be probably the size of Brazil. It would, as far as economic weight to Nubank goes, right? There's there's an enormous Latin-speaking, Spanish-speaking, you know what I mean, Latinx, as they call it. There's an enormous Latin population in the United States, Spanish-speaking, who would be extremely compelled to go with Nubank, and of course, Nubank is a Brazilian company, but they operate in a lot of Latin, in a lot of Hispanic, Spanish-speaking country. I'm sorry, I'm tired. You know what I mean. It could be a huge market if Nubank goes after the Latin, the Latino community in the US. It could be a very, very, very huge market. If you add, for example, remittances to that, it could be an even bigger market. And could it be a threat to SoFi? Probably not. SoFi is used to having a lot of competition. By the way, these two stocks are going to have to deal with X money pretty soon. So I think they're pretty good and pretty well used to competition. But to me, the fact that Nubank wants to go after the US market, especially Florida, to me is a huge selling point, and I find that very interesting. I don't understand why these stocks are so cheap. They grow very, very fast. They're the neobanks. They grow super fast. I like them very much. And of course, Nubank, if you look at the investor presentation of Nubank or SoFi, it's all the way up and to the right. It's all the way up. It's stellar charts. These charts are stellar. And lastly, the last stock I want to talk about, and of course, on this channel, I've praised Robinhood before. You know that I like Robinhood. I think Robinhood is a great stock. Would I buy Robinhood right now? No, I think Robinhood is a little bit expensive right now at a 0.44. But here is what I do not understand. There's two companies. There's another one, eToro, but eToro is a little tougher to analyze, so I'm not going to talk about eToro. But eToro is depending on the metric, equally as cheap as Webull. But Webull, I think, is kind of the biggest copycat, of Robinhood in the United States. I know people who use Webull. It's actually a popular platform, but you can see it's let's call it 12 times cheaper. Webull is 12 times cheaper than Robinhood. Of course, they're smaller, right? I think the assets of management at Webull are something like a little more than 10 times smaller. Of course, they're smaller. But as far as the numbers go, I mean that doesn't warrant these multiples. If you look at the multiples, I mean, you're looking at enterprise value over adjusted EBITDA for Robinhood is 35. You're looking at a 5 for Webull. For Webull, enterprise value over EBITDA is a 5, right? It's trading at a fraction at 80% of next 12 months sales. Right? This is kind of crazy, right? Gross profit is trading at next year's gross profit, essentially. I mean, it is so cheap. And Webull is slightly different than Robinhood in that, yes, they are much smaller, but Webull has a lot of options traders. They focus a lot on options traders. If you listen to the Webull call, they will tell you, yes, our stock trading volume is much lower, and of course, our assets under management are much lower. But they will say, we do 30% of a Robinhood business in options. So Webull is a third as big as Robinhood when it comes to options trading. So Webull is kind of like a platform that people love for options. And options are very profitable, of course. So I don't understand this, and I especially don't understand it in the light that Webull is down 55% and Robinhood is down 100%. There are going to be multiple neo-brokers that win, I believe. There's going to be multiple ones. And the market is kind of like selling off Webull, I don't know, like a punching bag, yet another punching bag. But I mean, to be fair, it sold off Robinhood too, but it sold off Webull much more than Robinhood. I don't think the delta between these two companies should be that big. I don't think it should be that big. You're talking about Webull being 12 times cheaper here. Remember, whether it's Robinhood or Webull, these businesses are very sticky. Once the money has moved to these businesses, they tend to stay, especially if you have options in place. And a lot of our options trade in place going multiple years out. These businesses tend to be pretty sticky. Also for these businesses, and I'll conclude with that, for these businesses, remember that the difference between gross margin and EBITDA margin for these businesses can be mostly explained by marketing expense in the form of bonuses. To get the customers to move the funds. So a large portion of the marketing expense actually goes back into asset under management and goes back into trading, which, if you ask me, is a pretty genius use of your marketing dollars. If you're going to have marketing dollars, you invest your marketing dollars in your customers, and then they stay on the platform, and you have AUM on which you earn your fees, your trading fees, your order flow fees, all of that sort of stuff. So I don't understand the delta. I like Robinhood too, but not at this price. I don't like Robinhood at this price. I like Webull very much at this price. So anyways, Kind of a throwback video. Hopefully you were able to listen to it as a podcast. Hopefully you're not too bored just looking at the spreadsheet. But anyways, that's just the style for today. This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.